Up-and-coming networking company Cloudflare reported earnings last night, and shares are down more than 25% in pre-market trading. So what the heck happened to the company? Well, let's spend the next 10 minutes trying to figure that out. My name is Brian Stoffel, and as of the time of this recording, I am a shareholder of Cloudflare, so I am very interested to see what's going on. Thanks to YCharts for sponsoring today's video. More from them in just a second. So this was Cloudflare's fiscal first quarter of 2023, and after that jump down when the market opens, it'll be about a $15 billion company. Now on the top line, revenue grew 37%. That's pretty solid. It ever so slightly missed Wall Street's estimates and it landed right in management's own guidance. So far, so not that bad. Earnings per share actually came in on an adjusted basis, well ahead of both expectations and where the company was last year. So far, so good. Gross margins ticked down ever so slightly. That is somewhat alarming. All of these are on a non-GAAP basis, but we'll talk about why that might be in a minute. But look at operating and net margins, both expanding meaningfully on a non-GAAP basis, which means it's not including stock-based compensation and some other items. It's worth noting free cash flow went from a loss of $64 million to a gain of $14 million. Over the trailing 12 months, the company has now produced positive free cash flows. Net income was up meaningfully, and the balance sheet is in okay shape with a net cash position of about $300 million. The number of paying customers for Cloudflare was up 13%. That growth slowed a little bit. The number of large customers on the platform was up 40%. That is very robust growth there. The dollar-based net retention rate ticked down. 170% is still a good mark. Management has said before that they want it over 130%. So you see right here that it's not going in the direction that management hoped. But what this means is Cloudflare is not only holding on to all of its customers, but it is seeing them spend 17% more year over year. In general, a pretty good sign if you're a shareholder. Here's one thing to know. When the company came public, when it came out in 2018, it just focused on application services. In 2021, it added Cloudflare One, which is network services, and Zero Trust, kind of some cybersecurity services. And this year it added R2 object storage for programmers. When you add a new program like that, an uptake might be a little bit slower. That could be what causes those gross margins to go down ever so slightly. So let's take a look at the company's at their income statement. Now we know revenue was up 37%, but the cost of that revenue was up 49%. Again, that is the tick down in gross margins. So the gross profit on a GAAP basis, this is on a GAAP basis, was only up 33%. We'll keep an eye on that. If it's a start of a trend, it could be alarming that they're having to lower prices because competition is coming in like Akamai, but we'll see where that goes. Now, it is worth noting that operating expenses were only up 30%. That is pretty good because that is slower than revenue. You want your expenses to grow slower than revenue. So overall, that's a positive sign, but it's worth noting that the swings in interest income make this the rest of the statement less useful. You see, they had about $1 million in interest income last year. In this higher interest rate environment, they're seeing about $14 million. And that can really swing things quite a bit for a company that's as small as Cloudflare is, which means the rest of this is pretty much meaningless. It is worth noting that while stock-based compensation remains high, the number of shares outstanding was only diluted by about 2%. We still don't love that, but it's not terrible. Overall, on a non-GAAP basis, this is moving in the right direction in terms of profitability. We went from operating margin of negative 8% in 2020 all the way to 7% in the most recent quarter. But if there was one thing that really caused the stock to go down, it was this comment from the company's CFO. Increasing macroeconomic certainty over the course of the first quarter resulted in a material lengthening of the sales cycles and a significant back-end weighting of linearity. Absolutely hate the use of language like that when all you really could say is the economy's in a tough time and our customers are taking longer to make their decisions to sign on, to use more of our tools. It's not all that different than, say you have a major remodel going on in your home and tough economic times hit. You might be ready to hit that button and say go for it, but once you see what's going on in the world around you, you might slow down your decision a little bit. It's really no different than that. So if we continue on, the company's guidance, as you can see, fell well short of Wall Street's estimates. It's worth noting on the bottom line, they believe they'll make more money than Wall Street expected, but right now this is where most investors are focused. Here's the real killer though. At the end of the last quarter, the company said the midpoint of their guidance for this year was $1.336 billion, 37% growth. Well, last night they revised that downwards, and now it's just 31% growth. And that is the big problem here. And as you can see, Wall Street was expecting more. The company does expect to be more profitable on a non-GAAP basis than Wall Street was expecting, but right now that's not the main story. So overall, what should you watch moving forward? That dollar-based net retention. Again, CEO Mr. Price is on record saying he wants that over 130. There's going to have to be a lot that changes to get it there, but keep your eye on it. Gross margins, just make sure that this is really a one-time thing, that it's ticking down ever so slightly on a year-over-year basis. You want to see those be stable. Listen in for the new product uptake of R2, and fourth, keep an eye on that free cash flow. Overall, I don't think that the moat is really widening too much. There's no evidence of that, but I don't think it's contracting either. The thesis for the company is still very much on track, so it gets a 10.5. You notice that scores down a little bit for me, but that's because of how I've changed how I define some of the things that I measure. Last time Brian Feroldi ran it through, it got a 78. My guess is it would be down a little bit, but why is the stock down so much if all of this is not great but not terrible? The reason is valuation. And to talk about valuation, we need to see, where is this company in its growth cycle? I would say that it is either exiting stage 2, entering stage 3, which means that we can look at price to sales, price to gross profit, something called price to earnings power. But for those first two, let's get back to our sponsor, YCharts. If you want to use YCharts, you can mention Brian Feroldi's name, get 20% off, and you can start your free trial at YCharts by simply clicking in the show notes below. So we head on over to YCharts, and the company's price to sales ratio before close yesterday was about 20. Once the market opens today with the stock going down and sales actually going up, it'll be at about 14, which is very high, but as you can see, it's about in line with its lowest points over the past couple of years. If we look at gross profit after yesterday, gross profit sits at $797 million. If we assume a market cap of about $15 billion, we get a price to gross profit of about 20. Again, that's quite expensive. But what about this thing called price to earnings power? Well, the way that this works is we ask ourselves, if Cloudflare was optimized for profit, what would it be trading for then today? Now, this is just hypothetical, so don't take the results of this too seriously. It just tries to give us a feel for the valuation. So when we do that, we can look and say, well, what could its profit margin be? Well, the company actually offered up this slide, and we see in the lower right-hand corner, they think they can have operating margins of 20% plus. I'll just say, all right, well, let's just say that means your net margin would be about 20%. If that's the case, then we've got something to work off of. And we can head on over to this tool that Brian Feroldi, Brian Withers, and I made. And what you do is you just input the ticker symbol here, NET, which is Cloudflare, we'll fill in. You've got to figure out what the revenue is over the trailing 12 months. I added in the revenue from yesterday, and it's just over $1 billion. And then you put in what that profit margin is, that it could be 20. So you get that, and then it does all this math. Now, it's worth noting that the market cap here at first was what it was when the market closed. I'm filming this, and the market hasn't opened yet. So I filled in the market cap of $15 billion here. So if we assume $15 billion market cap, and we assume that they could earn 20% profit margins, even with the fall today, it's trading right here, you can see, at about 70 times that earnings power. Even if it gets up to 26% profit margin, it would be trading to 55 times that earnings power. Overall, that is pretty high. And so I still think, so the company, not executing to the moon, but not doing terrible. But this valuation is a big reason why the stock has fallen. And so I ask myself, how attractive is this valuation? And I would say it lands somewhere over here, which means that I'll take that point, one more point off, and it ends it at a 9.5. So does that mean I'm going to be selling my shares? No. I think that the company has hit tough times, but those are mostly macroeconomic in nature with the growth slowing. I could be wrong. I'm going to keep my eye on it to see if I am. But I also made it such a small part of my portfolio that I'm in no rush to go out and change anything. If it's a larger part, then I wouldn't blame you if that's something that you needed to do. Overall, this is something I'll be keeping my eye on, checking back on it in 90 days. And if you'd like a copy of that earnings power presentation, simply click on the show notes below. Until then, Brian out.